if they're independent, I can just do IRA, IRB. If they're greater than the MAR, I'll just choose them. Okay. If they're mutually exclusive, well, I need to rank them, therefore I need to do that. But what about if they're mandatory? So I'm saying, I've got A and B, and I have to do something. Is there part of this tree I don't need to have to do, and still get the right answer? The way it's structured, I'm looking at A versus do nothing. Well, do nothing is not possible, because I have to do something. So what about if I say, if I have to do something, and the government's forcing me to do it, then I'm probably going to spend as little money as possible, which is A. So I'm going to do A anyway. Whether it makes money or not, I don't have a choice. I've got to do it by law. The only thing that's now within my realm of decision making is, should I spend more money because B saves me money? So in the mandatory project, can I not get away with just doing that? I have to do A, I'm going to do the cheapest thing to get this thing done. And therefore, I'm only going to spend more money if B saves me money. So if it's pollution control, I've got some equipment that, because it costs more, it has refinements, will save me more green energy. And that, over the long term, will benefit my company. So if it's a mandatory project, I can get away with simply this part of the tree. B minus A, if it's IRB minus A is worth doing, spend the money on the more expensive pollution control equipment or whatever the mandatory equipment is. If not, just go with the cheapest one and cut your loss. Yeah. So think a little bit about the relationship between the projects before you jump into a problem. Now, for the problem at hand, first of all, any questions? Okay. For the problem at hand, the information that we glean from the problem is that A and B are mutually exclusive. Okay, so now we're going to this problem specifically. In other words, they're competing alternatives to do the same thing. They just do the same thing differently. And I only need one. But they're not mandatory. So if it makes no sense, I'm not going to take either. From that point of view, I can't assume that A is worth doing if it's not mandatory. I have to consider, is the cheapest one worth doing? And then if it is the incremental expenditure worth doing as well? Okay, so that's the approach we're going to take. So the first part of it, and again, the company uses IRR to evaluate it. So let me first look at A and see how we might evaluate this. And now, this is very, very similar to a bond yield type question, or a rate of return type question, where we want to figure out, well, what's the rate of return on investment? Okay. And whether it's an IRR or a bond yield or a stock type problem, it's all the same. Yes, sir?
Sir, my question is that if B and A both return MARR, is it better to do the rate?
You're indifferent from a value point of view. So you might say, well, let's preserve capital and do A because it costs less. But from a pure value point of view, they're the same. So we're indifferent. But I think usually you want to ration capital, and so if you can get the same results for spending $7,600 or whatever the number is, $7,600, that's what you would do. Okay, but you're indifferent. So I've specifically excluded that because that almost never happens. But if it does, you probably want to spend the least amount of money to gain that for it. Okay. Okay. So in terms of the algorithm now, I'm going to look at, well, do nothing is possible, right? So it's not mandatory. And so I'm going to now consider A versus do nothing, or really A by itself. And what do I need to do? Well, let me first of all create the internal rate of return equation. So the IRR equation looks something like this. Take the present value of the cash flow, 2,500, you give an A. I'm going to say, in this case, I don't know what, I'll do this. IRR, comma 4, minus 7,600. Okay. So solving that will give me the internal rate of return of A, which will help me decide what to do from over there. Well, how do I solve it? Well, if I'm going to use the bond yield type approach, I've got trial and error and linear interpolation in the absence of having a computer to solve this numerically for me. My suggestion is your first trial will always be the MAR. The problems are on a quiz or a final are always set up so that if you start with that, you'll very quickly get the boundary condition. Okay. So in this case, start. In other words, for this IRR, since we don't know what it is, let me let it equal I. Let's start with the MAR equals 10%. Okay. That'll tell us whether the project's worth doing. Okay. Well, this is always set up so that you can use the tables in the back of the textbook. What do I need? Well, I need the P given A factor, I comma 4, okay. And that's 3.1699. And I can do now this calculation here, and I come up with $325. So it suggests that project A is worth doing because it has a positive present value at the MAR of 10%. Okay. Now, in theory, that is enough to proceed because I know that if the net present value is greater than 0, the internal rate of return of A will be greater than the MAR. And so I can proceed down this part of the tree. If the question specifically says, calculate the IRR, then you have to do it. In this case, what we can say is it's going to be greater than 10%. How much greater? Well, let's try the next interest rate factor in the back of the text box, which you'll find is 12%. You can use 11, but then you have to do calculation. So use 12, and you don't. Then you can come up with this factor just by looking it up. And you can calculate this very simply. Minus stuff. So if the MAR had been 12%, this project wouldn't have been worth doing. Well, what does this tell us then? This tells us that somewhere in between this and this is IRRA, where, of course, it's equal to $0. Okay. This is where your linear interpolation comes in. Let me assume that in between 12% and 10%, the net present value, which is really represented by this equation, which is definitely not linear, is more or less linear. Calculate the slope between these 2 points, and then say, well, that's equal to the 2 points that I want to know, IRRA, and either 12% or 10%. Doesn't matter what. Well, if I do that, so this is now the trial and error, okay, for the guessing part. The linear interpolation basically looks like that. I'm going to say, well, let me look at between 12 and 10%. So the slope of the net present value curve, assuming it's linear, looks something like this. So that's simply the slope, assuming linearity. And of course, if I make the assumption that it's linear in that region, then why don't I just say the difference between the slope between here and here is the same as the slope between here and here. So I got minus 7, minus 0, 12, minus IRRA. Right, because at IRRA, they have to be thing is 0. If I solve that, what do I get? IRRA is equal to 11.96%. Okay. So, start with the MARR as your first guess, and that'll determine if this number is positive. Well, you're going to go greater because IRR is going to be greater than your MARR. If that number is negative, well, then you're going to go with an MARR or an I that's less than 10%, 9 or 8% on the table. Okay. So this suggests that A is worth doing. And so we're now coming down this side of the tree. Well, if A is worth doing, what about B? Well, B has a 1-year economic life, remember, and therefore, I'm going to reinvest 3 more times to make sure I can provide the service for the next 4 years. Okay. And again, we're using a real cost of capital, therefore, these are all constant dollars, there's no inflation, and I can fairly easily, with no inflation, say I can buy it again next year, run it for a year, finally, right, if it's a 4-year project, I've got to buy a 1-year machine 4 times. Of course, I don't need to buy it here, because that would be for year 5, and that's outside my project time horizon. Okay. So now I've got some cash flows that look something like this. Okay. Well, so I've got minus 9,500, and the delta between buying and revenue, or net revenue, is this. And then I've got 12,000, because I don't have to buy the machine in year 4. I know what I have for A. And what I'm after, because I'm going down this part of the tree, is B minus A. And so it basically nets out like that. An extra $1,900, what does it buy me? Well, nothing for the 3 years of the project until the very end, and then they have 9,500. So the entire issue is, well, what's the rate of return now on this extra 1,900? Is it worth doing? Well, similar approach. I've got essentially, let's see, what do I have here? I've got, I'm going to draw here. I've got 0 equals minus 1,900 plus P given F, IRR B minus A, comma 4. Again, the 9,500. Well, this is a little easier to solve directly, because this factor here is simply a 1 plus I. And so if I substitute, I'm going to get, well, remember, P given F is simply 1 over and 4. Yeah, please.
Isn't that IRR going to be over 100?
Sorry?
Should that be over 100?
Over 100?
1 plus IRR be like over 100. What's the percentage?
Sorry, IRR?
Yeah.
No, that's, no, this is just a symbol for a number. It's going to be, point something. Right, when I solve it, I'm going to get I,
Okay.
right? And then I can multiply by 100 if I want the actual percentage. Okay, so it's just it's not a percentage yet. Okay, and so I can solve that taking the fourth root, and I will come up with IRR B minus A of 0.495 for a very healthy incremental return. And this is where the 100 factor comes in, of 49.5%. So sometimes if a lot of terms drop out, you can actually solve it. You can always be on the lookout for it simply being something you can directly calculate. Okay. So if I go back to the decision tree here, I'm going down IRR, A greater than 10%. It was 12% or whatever. And now B minus A, the IRR, is almost 50%. And therefore I'm going to go down the tree that says, oh, recommend B. Okay. And so B will be the project that adds the most value to the company.
If you just simply calculate IRRB and compare with IRRA, do we get the same result, like suggesting IRRB, suggesting plan B is better?
You might, but not guaranteed. Okay, because we showed you some examples earlier of an A versus B situation where there was a net present value profile, and for certain costs of capital, it was the contrary recommendation. So IRR recommended B rather than A, when indeed A was the one that had the most value. So on a test, if you simply do IRRB and IRA and happen to get the right answer, because it just works out that way, that's not acceptable. because you're not guaranteed that that method will give you the right answer. Okay. And, you know, if you go back to, I guess when we first started talking about, there's an example that will show you that indeed is the case. Please.
Oh, sorry, never mind.
Sorry. Yeah.
What if you had the answer for IRR B minus A equals 2%?
Okay.
Then would you recommend A or B?
Then, okay, so in this case, 50%. If IRR A minus B happened to be 2%, then you'd be going down this side of the tree.
Okay, but isn't the incremental the difference between project B and project A?
Yeah. And so what we're
Basically what I mean is, isn't this IRR already, we already know that it's more than MARR because A's IRR is more. Right, that?
Well, what this is measuring is what is the return on spending an extra, what is it, $1,700? $1,900.
Oh, okay.
So we're asking, we know that if we spend $7,600, that's a good investment. Okay. And what we want to do is, if we spend another $1,900, is that money well spent?
Oh, so you better off give the money to.
You've got, yeah, for that $1,900, we've got good engineers in our company, and they can spend that on projects that will return. So getting 2% on that money makes some sense. Let's stop at A. That's the way to look at it. Yeah.
If you're allowed both projects, will you be just comparing individual IRR?
Yes. Yeah. So if they were independent, okay, or you could do both, then all you have to do is IRR A, IRR B, which is of course different than B minus A, and your test is simply budget line, independently. And then you're guaranteed to get the right answer. The problem comes in when you have to rank them. Because again, IRR might rank things differently than NPV. But NPV measures, because we're reinvesting cash flows at the cost of capital, measures the true value of a project. And this just happens to be a popular method. Okay. So again, just simply don't do IRA, IRB. You're not guaranteed to get the right answer. Okay, well that takes us up really to the end of the chapter 4, which is the coverage on quiz 3 next week. And I was going to write down what is on it, but I'll just say chapter 3, chapter 4, okay, up to the end of week 7 in the lecture notes. And remember, there are some optional sections in the textbook that are on the core syllabus, which we will cover. 2 questions, I think. One is going to be a financial analysis of some type of Chapter 3 security that we talked about, and the other one is going to be a Chapter 4 project analysis. Okay, so I think I'll just stick with the 2 questions, so we'll have plenty of time to read, understand the question, and then just, sort of go to it and solve it. Okay, so that's the fun. Well, what I'd like to do now, if there's no question, any questions? Chapter 3, Chapter 4? Okay. I want to now start talking a little bit about the Income Tax Act and how it affects our engineering projects. So up until now, we've been looking at projects on a before-tax point of view, from a before-tax point of view. And of course, you can't spend before-tax profit. You've got to pay taxes on it. And we need to consider, well, how does the Income Tax Act in Canada, and to a lesser extent in the United States, affect our engineering projects? So what I'd like to do is just initially talk about the Tax Act and the motivation and behind it, and why things are as complicated as they are. And I want to touch on your lives as corporate engineers in terms of corporate income tax, but also in terms of personal income tax. What sort of taxes will you be paying once you get out of here? Now, I want to start out with a very simple question. What is the purpose of the Canadian Income Tax Act?
Take your money away.
Take your money away. And it's failing if you have any money left, more than just to meet the basic necessities of life. So the goal of the system is to extract the maximum amount of money of Canadians for the privilege of living in Canada. Well, perhaps. Very cynical view, because many folks think, well, we get all these benefits that we should indeed contribute to, basically, for all of these benefits that we receive. We'll talk a little bit about when the system breaks down in terms of, what is it that you want in an income tax system? Obviously, no one likes paying taxes. But if you need to have an income tax system, what are the characteristics that make people say, well, yeah, I don't want to pay tax, but I don't feel too bad about it? We'll talk about that a little bit. Well, why is income tax so complicated? Well, if all it was to raise money, why not just have 2 pages of the law, Canadian Income Tax Act, and say, we'll just tax everyone 18%, that's enough to pay the bills and we're done. Well, the politicians in Ottawa have spent the last 100 years almost creating a 2,000-page income tax act. Here it is. Fine print, paragraph after paragraph, clause, subclause, you name it. You know, you need, well, at least I need really strong glasses to be able to read some of the clauses in here. Why? Well, governments use the Income Tax Act to implement policy, social policy and economic policy. Sometimes very difficult to pass a law telling people you can't do this. But it's easy, much easier to pass a law saying, well, you can do whatever you want, but if you do it the way that we want, we're going to make it interesting to you in terms of tax savings. So it's really an incentive program, and we'll talk a little bit about it. Now, what about in terms of individuals? Well, the government believes that it's appropriate for individuals to set aside a little bit of their income each year to fund their retirement. Why? Well, there's going to be a lot of old people 50 years from now, the government won't be able to pay all the benefits. And so many people don't want to do that, but there's a really lucrative program, a registered retirement savings plan, that encourages people to do so because it changes the after-tax returns. And we'll show you how that works in a second. Secondly, from a corporate point of view, governments often like to basically encourage certain industries because they think, well, Canada has a niche here, we've got some real talent, let's just give people a competitive advantage over the rest of the world. For example, government encourages the satellite industry in Canada. So how might you do that? Well, what about if I'm an engineer and I've got to put a nationwide data communication facility in place? Right? Well, if I do before tax chapter 4 analysis, let's say, I've got microwave and fiber optics across the country and I do a costing of that. And then I say, well, I can only use satellites, bounce it off and down, and project can analyze that as well. Well, if before tax, the terrestrial facilities have the better return, that's what I'm going to do. And I'm not going to buy satellite services, and I'm not going to encourage the satellite industry. But let's say the government decides, and we'll talk about the mechanisms later, that there's going to be preferential treatment if I decide to use satellite technology. Well, all of a sudden, the Chapter 5 analysis after tax is going to be different. And satellite technology is going to come out ahead. And I look at net present value after tax, I'm not going to choose terrestrial, because after tax, I don't care where the money comes from, whether it's taxpayers or my customers, I'm going to choose the satellite technology. Hence, there's basically an encouragement through the Tax Act in terms of that industry. And dollars flow into the industry, it flourishes. Secondly, the government believes that, and especially if they want to get reelected, that the economic sort of wealth of Canada should be sort of shared across the country, in Canada more so than perhaps other countries. And to do that, you have to basically have jobs across the country, because that's what generates wealth. Well, let's say, I'm a manager and I'm deciding where to put a plant. Well, we're going to put a plant in Central Ontario because that's where our customers are, and that's what we do. But there's all sorts of employment, let's say, in Newfoundland or Labrador. The government can't pass a law that says you cannot, Mr. Factory Manager, put a plant in Central Ontario because they've already got more than their fair share of investment. It's not fair that you put your plant there. They can't pass a law that would never pass. But they can, through the Tax Act, say, I don't care where you put your plant, but you put your plant in Newfoundland, and we'll pay half the salary of your people for the next 2 years from tax dollars. We'll give you accelerated capital cost allowance. We'll give you tax incentives on property. We'll do all of this. Then you do your analysis and you say, well, who do we want to locate in Central Ontario? I've got a supercomputer example, which is out on Cape Breton Island, which is known as Nova Scotia. One of the most lucrative programs that makes absolutely no sense is Cape Breton Island. And I'll show you an example where the only reason they put it there and the project failed was because of tax incentives. See how that works. So the government can't basically legislate, you can't do this. But they can legislate, well, we'll make it interesting for you. And I'll read you a portion of the Tax Act in a little bit, just to show you what you're up against. So, I teach this course to the telecom industry, and few years ago, one of our students from Quebec observed sort of an interesting observation. He said, well, you know, through the Tax Act, the government included all sorts of activities. And he was backing up his case in terms of, in Quebec, there's a baby bonus for your third, fourth, and fifth child. And his conclusion was, the Tax Act even influences activity in the bedroom. Because it's a benefit. So, you see, it's all pervasive. And as engineers, of course, you know, we're not expecting people to be tax experts. But we're expecting our engineers, and, you know, in the private sector, you have to ask the question, well, how does the Tax Act affect my projects? Now, you might say, well, you know, take a percentage of your tax, you know, your revenue and taxes, and everything's neutral. I don't really need to know. I'm going to show you two examples, and one is in telecommunications, where making the right decision and adding, let's say, $1,000 worth of stuff to a $10 million switch will save your customer over $1 million over the life of the asset in taxes. And if you don't know that, and you didn't do that, you haven't got a hope of selling that switch in Canada. So it can affect engineering design. And it's just knowledge of the Tax Act, but more importantly, knowing that you have to ask the right question and seeking the advice of experts who spend their entire lives looking at this book. And sadly, tax experts perhaps make it even more than engineers. You know, just studying what's in this book is of value simply because you can save $1 million on a $10 million switch. So we're not expecting to be experts, but what we're expecting everyone to be able to do is ask the right question. How is the Tax Act going to affect my project? How can I juggle the design to minimize the taxes we pay or the taxes my customer pays? That's what we're after in this forecast. Maybe I'll start. Let me show you what you're up against. Has everyone in this room given someone else a gift? Of course, right? Well, I hope you've done so in full compliance with Section 110, paragraph 2.2 of the Income Tax Act. This relates to giving someone a gift, and it's in English. Gift of a tangible capital property. Tangible, something you can touch as opposed to some software, let's say. Where at any time after 1971, the rules changed in 71, a taxpayer has made, whether by his will or otherwise, a gift of capital property, we talked about capital goods, right, to a donee, described in paragraph 1A or B, or subparagraph 2. In the case of a taxpayer who is a non-resident person, real property situated in Canada, to a prescribed donee who provides an undertaking in a form satisfactory to the minister, to the effect that such property will be held for use in the public interest and, part B, the fair market value of that property at that time exceeded its adjusted cost base to the taxpayer. Now we get into the really interesting stuff. Such amount, not greater than the fair market value, not less than the adjusted cost base to the taxpayer of the property at that time, as it designated by the taxpayer or his legal representative in his return of income under Section 150 for the year in which the gift was made, shall, if payment thereof is proved by filing with the minister a receipt containing prescribed information, be deemed to be the taxpayer's proceeds of disposition of the property and the amount of the gift made by the taxpayer. Giving a gift. And of course, ignorance of law is no excuse. What does it mean? It's English. Well, I want to sort of an interesting example for small family businesses. What it's basically saying, I mean, does anyone, what does it say? I mean, mercifully, Revenue Canada has interpretation boards, hundreds and hundreds of them, where you can actually see what they think this means, okay, and get their interpretation of it, which will give you some guidance. Okay, think about a small family business here, and think about a business that has been started from nothing. So, mom and pop started in their basement. Didn't really cost them very much. And they've been working on it for a long period of time. And let's say the business value right now is $1 million. Right? And, you know, you get it appraised based on revenue and profit, and, you know, your equipment in place, your customers and all of that. You come up with a number. Now, they want to retire, and they, since it's a family business, would like to give it to their son or daughter. Again. Right? Now, they worked hard, it's theirs, so you would think that they have the right to give it to their kid. And the answer is yes, they do. Okay. Now, there is no gift tax in Canada. So if, one of you were lucky enough to get your family business for free, there's no tax because there's no gift tax. However, the key word in that paragraph or two is the word deemed. Deemed means we will act as if you have. Okay? And the deemed word here means that the parents are considered to have sold the business at fair market value, which of course triggers tax consequences. Okay? And so, even though they didn't get a penny because they gave it for free, they are deemed to have sold it for fair market value, which is $1 million. We'll talk about how taxes work throughout the next couple of weeks. But this is called a capital gain. So if you make money in the stock market, or if you make money, you have a business, a capital asset, you sell it, you don't get taxed at the same rate as making money as an employee. In Canada, what happens, and similarly in the United States, is half the gain is tax-free. Okay? But half the gain is taxable. So in other words, even though the parents didn't get anything for this business from their son or daughter, they're deemed to have sold it for $1 million, which means that they have $500,000 worth of deemed income. Deemed income. And let's say they're fairly well off. Well, in the province of Ontario, the marginal tax rate, as we'll see, we'll talk about personal rates, is 50%. So they've got to come up with a tax, or they're going to get a tax bill of $250,000 as a result of this gift. Okay. Now, let's just say they didn't know, and they give the gift. Don't do anything. I didn't know. It's too complicated. I read it, but I didn't understand it. What happened? Well, of course, Revenue Canada auditors are looking at transfer records to see whether or not businesses get transferred, or whether houses get sold, or businesses get sold. And 2 or 3 years down the road, they're not really quick, they will see on the computer somewhere that this business all of a sudden went from, Mr. and Mrs. whomever to son and daughter whomever. And they will go to the tax records of the parents and say, well, did they declare this? The answer is no. And of course, they get audited. The taxes are, of course, payable. The penalty, equivalent to the taxes, $500,000 now. So rather than paying $250,000, they got to pay $500,000. And of course, interest from the time the taxes should have been paid compounded daily. So it's in your interest when you have a big transaction to figure out what you should do. What are the chances of not getting caught? Well, business registry records are public, right? And Revenue Canada knows where to look. So, the I don't know argument simply doesn't work. So, especially as engineers and projects, we have to basically make sure that we conform. Now, how do we play games here? How do we play games?
What if you were to hire the son and daughter and they became the owner of they got promoted to the CEO of the company?
Okay, so they're CEO, and let's say they get all the profits. But think about what happens, because all of us eventually will pass away. Okay? Now, the government's got that covered too. Because when you pass away, they've been in the business for quite a while, so they know all the angles. The parents passed away. Well, the estate is deemed to have sold it. Same thing happens. Let's say the son or daughter is in the will. Well, the estate, which is essentially a legal representation of the deceased, pays the taxes like this. They're deemed to have sold it for $1 million. Okay? It defers it, but think about if the business is worth $5 million 5 years from now as opposed to $1 million now. Maybe you want to pay the taxes now. Especially if the son or daughter are really good at managing the business and creating value. Sir? Sell it for $1. Okay. Well, you're a little more daring than I. What about selling it for $100,000? And we'll actually have a check from the son or daughter to the parents for $100,000. Maybe the parents actually gave $100,000 worth of cash to their son or daughter so they could actually write the check. Well, you now, the parents, of course, on their property, on their income tax, declare a $100,000 sale. They will pay a tenth of the tax, $25,000, and then they may or may not get audited. Government official auditor will have a look at the transfer, and if it's a small business, they may say, well, okay, that's fine. Or they may have a look. They have a look, same problem. Except now, you're only in arrears by $225,000 with a $225 penalty and interest compounded daily. So the key thing is, let's just say, if we had it valued at $900,000, okay, so this is what we call, there's two terms, tax evasion, tax avoidance. Tax evasion is not following what's in that book, breaking the law, and there's very serious penalties for us. You can go to jail. Tax avoidance is structuring your affairs, and that's what we'll talk about in this course, structuring your affairs to minimize your taxation. And that is the stated policy of Canada Revenue Agency. Every taxpayer should pay exactly what they owe, no more, no less. And every taxpayer is entitled to arrange their business affairs to minimize taxation according to that book. That's tax avoidance. Perfectly legal, perfectly desirable. This is tax evasion. Now, if you had a valuation done of $900,000 and you got audited, and the Revenue Canada auditors came in and had a look, and they valued that at $1 million, well, that's less of a sin, because you did your best to get a valuation. Revenue Canada says it's worth something else, and you would probably just have to pay the taxes and interest. There would be no penalty, as long as you could substantiate that you had a best effort estimate. So there's a difference between honest errors and honest mistakes. The taxes are forgiven, but the penalties might. But certainly, declaring at $100,000, that is tax evasion, and not declaring at all is tax evasion. And there's gray areas that we're going to talk about. And if you're in small business, you can exploit gray areas to your advantage, and we'll talk a little bit about that. Gray is sort of in between right and wrong, and it's closer to tax avoidance rather than tax evasion. Okay. Now, what about RSP? Because we like to talk about the personal side of things as well. Registered Retirement Savings Plan is very, very popular in Canada. And again, it takes a few pages in this book to describe what to do. It's fairly complicated. Seems straightforward, but if you leave a company or you do this and that, you have to decide what happens to those benefits. Okay. Now, what about if you have, let's say, you're out in the workforce and you've got $10,000 of income above your needs. In other words, this is stuff for savings. Okay. So you make a good salary and you have $10,000 in income that you don't need. And let's say you don't believe in government programs, not that. And you decide to save this money. Okay. Well, first of all, let's talk about a reasonable tax rate. If you're a professional engineer, at the margin, and we'll define that term a little later on, you will pay tax around 40%. So in other words, work $1,000 overtime, government takes $400, you get $600. So if this is at the top, okay, you will pay, basically, so you've got this income, and I'm going to say, no plan. You don't want anything to do with government. So I've got $10,000. Okay. The tax man basically says, I want $4,000. And you have, after tax, this is what we're going to define in this term, after tax, or in this course, after tax income, and actually spend $6,000. And let's say you're reasonably conservative and you want to put it into a mutual fund of bonds. You want to buy into a bond, mutual fund. Well, what do you got? You've got $6,000. Okay? And so now I'm going to have a mutual fund investment. Let's say it pays 5%. Not a bad number. Okay. Well, here I have $300 worth of before tax income each year. All right, so I put $6 grand in, buy into the fund, it pays me 5%, $300 a year. Well, interest is taxed just like working. Okay. Unlike capital gains, which is taxed half like working. And of course, at 40%, okay, I have $120 tax bill, which means I have, again, after-tax interest of $180. So look at it from this point of view. I got 10 grand of income, and I'm earning $180 a year. I might as well spend, what is that, 1.8%. Okay. Let's say you're going to look at the RSP. Well, what happens is slightly different. Yes, you've got $10,000 worth of income. And yes, if you're working, you're going to have your taxes withheld. But make a contribution to a registered plan. So you register with a bank or a trust company. It's a government registered plan. Make the contribution. Around probably February, they're going to send you a tax receipt. And a tax receipt will be a deduction. We'll talk about how that works a little later on, which essentially nullifies the tax. So this is the tax, and then this is the benefit of the deduction. Benefit of the deduction. So in other words, I get a tax receipt, I send it along with my income tax, end of April, and I essentially pay $4,000 worth of tax. Which means I have $10,000 available for investment. Now, I'm going to put it in the same, because I want apples to apples comparison. Same thing. I get $500 interest. Nice thing about an RSP is I don't pay any taxes on any growth or income within the RSP. Tax free. So what do I have? I've got $500 a year interest. And so that's like 5% a year. Almost 3 times as much. All of a sudden it gets interesting. Because people love to save taxes. Millions of Canadians sign up for this. Now this seems too good to be true. What's the catch? There's always a catch. What do you think?
Tax the crap out of it when you actually take it out when you retire.
That's right. When you retire, it becomes income. Now, what happens when you retire? Usually, so many people around here retire, then they come back and work and double dip. But you don't have a job, right? You just got a pension income. And therefore, when you're working as a professional engineer, especially on your career, you're going to be paying 46% tax. But when you retire, you're going to be in a much lower tax bracket, and so you may only be paying 10 or 15% tax. Okay. So the savings are, in terms of, you get the deduction right now at 40%, and when you take it, when you actually cash out, you're in a lower tax bracket, you're going to pay less tax. Okay. So yeah, they got you there. But if I decide to take it out while I'm working, I'm going to get hit with 46% tax if I'm going to my career. But think about from a time value money point of view. Yes, even if I have to pay lots of tax 20, 30 years from now, do I not have the full $10,000 working for me? And do I not receive all of the interest working for me? And think about, let's say, a P given F at 5%, that compounding value of money, versus a P given F 20 or 30 years from now of 1.8. A huge difference. So I've got money that I would give the tax man. I've got it working for me for 20 or 30 years, and the future value of that is huge compared to the other alternative. So I've got time value money working for me because money I would have given the government working for me. Now, this is perhaps more important for arts and science students and not engineers, but if you find yourself without a job somewhere throughout your career, it means you're not paying much tax that year, right? So this is a rainy day fund. So if I'm out of work for a year, I don't pay any tax, and let's say I take out $20,000 or $30,000 to get me by, I will only pay 10% tax because I'm not making much money. So this is also a rainy day fund, not to be taken to go on a cruise or what have you when you're working, but when you're not working. Okay, so very, very popular, millions of Canadians do. And again, what do we have? We have a before tax return, okay, or sorry, an after tax return that's horrible, and then with the incentive program, one that makes an awful lot of sense. So we've got the government trying to help us out in terms of making the right decisions. Okay, okay, I want to just a couple more points and then we'll close. So, what I want to say is that we've got lots of folks who are experts in this. So we as engineers know our engineering, we know the alternatives that we have, we want to figure out what's the tax impact of those alternatives, which one gives us the most beneficial treatment. And we have the income tax to guide us, but as I've read that paragraph to you, it's not guiding us very much. We have Revenue Canada, who has interpretation bulletins. So they say, this is the way we interpret what the politicians in Ottawa and their lawyers have to say. Okay. Then we have the taxpayer, who looks at it and says, well, I don't agree with Revenue Canada. I think it means this. Okay. And then, of course, someone has to arbitrate. So if you have a disagreement with Revenue Canada, initially it goes to Revenue Canada, and you go through an appeal, and if you win the day, that's the end of it. But since this is the law, the ultimate arbitrator are the courts. Okay. And the courts will indeed look at this, and they'll say, well, this is what we believe it means. No, this is what we say it means, and this is what you have to follow in terms of the law. Okay. One of the things that Revenue Canada has done, and I'll talk about this next day, is they have come up with what they call the general anti-avoidance regulation. And what it says, it's called the GAR, the General Anti-Avoidance Regulation. What it says is that if you have a business transaction that is not one that one normally would have in the course of business, and that business transaction is designed solely to avoid taxes, we will deem that that is illegal. It doesn't necessarily mean that the book says it's illegal, because politicians never figured out that someone would do that. But they don't like it. And they say, general anti-avoidance regulation basically will mean that you can't do it. Now, think about for the next day. Is that something in law that we would want? Do we want a government agency that's supposed to uphold the law, make the rules as they go along, and say, we don't like that? So think about how the courts might react to citizens who have been involved with it. We'll talk about that.